Anti-money laundering, AML, is the set of laws, regulations, and practices used by the government and financial institutions to expose illegal money disguised as legitimate funds. What is money laundering? Money laundering is a financial crime that involves passing off criminally obtained money as legal or having legal origin. Criminals use money laundering to conceal illicit wealth obtained through crimes such as tax evasion, drug or human trafficking, public corruption, insider trading, illegal arms trade, and financial terrorist organizations. Money laundering works in 3 stages. Placing, which is how and where illegally obtained money is placed in legitimate systems. This is sometimes done through avenues like payments for false invoices or cash-based businesses like casinos, or through something called smurfing, which means putting small amounts of money below the AML threshold into bank accounts or credit cards. Layering. This is the process of creating complex layers of transactions to disguise the money's ownership and origin. Integration. This is the final stage where the laundered funds enter the economy disguised as money from a legitimate business or personal transactions. Money is often laundered through trade transactions, cash smuggling, and terrorist financing. Recently, crypto and virtual currencies have opened a new range of options for money laundering, mainly because they are decentralized networks. For instance, criminals may exploit the AML compliance holes in Bitcoin ATMs. They may also use tumblers, which are mixing services that charge a hefty fee for laundering money through various cryptocurrency accounts. Anti-money laundering is the government's effort to fight wire fraud and other financial crimes. Financial institutions must perform certain activities to achieve compliance with anti-money laundering laws. There are several reasons why financial institutions engage in AML. Banks comply with AML regulations that require them to monitor and report any suspicious or irregular activity to avoid the civil and criminal penalties they may face due to noncompliance. They use AML tactics to protect their brand reputation and shareholder value. Banks generally have to comply with principles such as customer identification programs or Know Your Customer (KYC). Suspicious activity reports or suspicious transaction reports, sanctions compliance, and large currency transaction reporting. Several countries have their local AML regulations. In the U.S., legislation comes as the U.S. Patriot Act and the Bank Secrecy Act help fight crime. Others include the 4th Anti-Money Laundering Directive, 4AMLD in Europe, Proceeds of Crime, Money Laundering, and Terrorist Financing Act, PCML-TFA in Canada, and the Anti-Money Laundering and Counter-Terrorism Financing Act of 2006 in Australia. In 1989, several countries and organizations formed the Financial Action Task Force, FATF, which aims to promote global standards for preventing money laundering. We hope you learned something new in this video. Please hit the like and subscribe buttons below and share this video. If there's a topic you'd like us to discuss, let us know by leaving a comment below.